All right, well, good morning, everyone. This is Scott Thompson, and we are here for our active trading, swing trading session, days to weeks. Today is the 13th of November. Great to be here with you. And as always, remind everyone our presentation today is for educational purposes, not a recommendation or endorsement of any particular investment or investment strategy. And past performance of any security or strategy does not guarantee future success. Options are not suitable for all investors, as special risk inherent to option trading may expose investors to potentially rapid and substantial losses. Spread, straddles, and other multiple leg option strategies can entail substantial transaction costs, which may impact your potential returns. Also be aware, in order to demonstrate the functionality of the platform, we will be using actual symbols, but none of those symbols are meant to be recommendations. Any investment decision you make in your self-directed account is solely your responsibility. Paper money software application is for educational purposes, and successful virtual trading during one time period does not guarantee successful investing of actual funds during a later time period, as market conditions are constantly changing. The stop market order does not guarantee execution at or near the activation price. Once activated, the orders compete with the other incoming market orders. Be aware also that all investing involves risk, and there's no soliciting, no photography, no rebroadcasting, and no part of the presentation may be copied, recorded, or rebroadcast without the prior written consent of TD Ameritrade. If you do trade options, be aware of how those option Greeks, delta, gamma, vega, and theta can impact your trades. And our goal today is really to go over some bull flag setups. We'll talk about swing trading in the context of a bull flag, although there are some stocks. The market sold off pretty heavily yesterday. Looks like the futures were up slightly this morning. A little bit. S&P looked like it was up about 7-8 points this morning. So we'll probably, after a big drop like that, technical traders start looking for small range days, harami type of candle patterns. Look for stocks to find some support here. So we'll see what happens. But ultimately we're going to talk about identifying what we call the setup. The setup is what the stock looks like before we get that bounce off support, before we get that breakout. But we want to be able to identify the setup. We're going to determine potential entry signals, price targets, and initial exit orders for these types of swing trades. Swing trades generally last about 2 to 5 to 7 days, maybe 10 to 15 days on the long side of things. And then we'll also practice placing a conditional order in the Thinkorswim paper money platform. And so let's just jump right in here. I want to go through the setup first. Again, the setup is basically, what kind of the picture we're looking for before we get our entry signal. We're trying to get ready to take action before we need to take action. I remember when I first started trading, it was seeming like, I should have bought that yesterday, I should have bought that 2-3 days ago. And I started asking myself, well, why didn't I buy that 2 or 3 days ago? And the answer just simply came, I didn't know what I was looking for. So what I want to tell you is the setup is what we're looking for. When we go through our watch list, we're looking for the setup so that we can be ready to take action when we get our buy signal. So specifically, this bull flag setup has 4 components. We'll go over those 4 components together. But you can use these same things for what I would consider a support bounce trade that's not necessarily a bull flag, okay? But a bull flag specifically does have 4 setup criteria. The higher high, the stock has made a short-term higher high in its trend. So you're comparing the current high you're looking at to the last high in the trend. Generally, after that, the stock will pull back for about 2 to 5 days. Some days, sometimes in a real strong uptrend, all you're going to get is like a 2-day pullback. Maybe it might even feel like just a 1-day pullback, but the stock pulls back a little bit in price, maybe makes a little bit lower close, and we look for that to happen about 2 or 3 days, 2, 3, 4, 5 days in a row. So as the stock's pulling back, we're looking for it to trade near support. So it pulls back to a support level. Now that could be like a Fibonacci retracement level. That could be an old resistance level becoming new support. Could be like the 10-day moving average, something like that. But basically, we're looking for it to pull back to a support. Another one that's pretty common is halfway through maybe a big bullish candle. Something's had a big old run. When it starts to pull back, technicians will look for a pullback point about halfway through that big bullish candle. And then the last thing, especially with a bull flag, what we're looking for is for the stock to make a higher low in its trend. So, we're identifying a previous low. The stock generally hits a low and rallies up from that point, and then as it starts to pull back, we want it to stay above that last low and make that higher low. Those are the setup criteria that we want to see. Okay, those 4 things: higher high, 2 to 5 day pullback, trading near support, and making a higher low. And those arrows, the first thing obviously would be the higher high. The last thing, or the fourth thing, would be that higher low. So that's basically the setup. And the idea now is when we identify that setup, we're going to try to identify our entry point. So what I want to do here is go jump over to a chart and take a look at this progression of a setup, and then we'll come back to the slides, take a look at the different entry opportunities, then go place some orders in the Thinkorswim platform. All right, so let me go over here to the Thinkorswim platform, and we talked about this stock actually in another class that I did a few weeks ago. We did what I would call a short-term trade. We traded this breakout when it traded above the 96.45. We got triggered into that trade, and so as is very common, the stock went up, came back, kind of tested that area as the new support, and then it started to rally up again. So what I want to go through with you today is kind of this progression. After the stock's broken out, after the stock's making a trend, we start watching for the next trading opportunity. Maybe we missed this opportunity, right? So as we move the chart forward, we can see, right here, we can see the stock had a little 3-day rally, and we obviously are making a new high in the trend. And so the question is, though, is this the high in the trend? And we don't really know this yet. We don't know if this is a high in the trend right here or not. Okay, now let me give you a definition of how we determine a high in the trend. A high in the trend is established when the stock closes below the low of the high day. So for example, the stock's rally here, this looks like a shooting star candle. If you've been through candle theory, if you go to my class on Friday afternoon, and technically speaking, we talk about candle patterns, we talk about price patterns, we talk about indicator-based strategies, but basically that candle right there on the 7th of November is known as a shooting star. Okay, now just because we get a bearish candle doesn't mean the stock's going to go down the next day. Technical traders prepare for it to go down, and they expect maybe it to go down, but it doesn't always happen that way. So that was kind of a hard way to look at this. But the question is here in the chat, does this apply to downward trend? Yes, it does. So the bear flag setup, and we'll probably do that in the future. But basically, yes, the bull flag, if you just flip all those criteria over, you'll get a bear flag. All right, so here we have a rally. Now, this is ESRX. The stock's moving up. It had some horizontal sideways motion, broke out, tested the breakout point. Now we're trending up again, making a new high in the trend, but we don't know if that's the high yet. So the low that day is $98.86. So if the stock closes below 98, below that 98.86, then basically we would say, oh, there's my high in the trend, and we could compare it to the last high in the trend. Now, technically I would say this last high over here, this red candle, we got the pullback there. Some traders might look at that as the last high in the trend. Some of them might look at it over here. But basically, this is kind of our shooting star. We don't know what's going to happen tomorrow, but if it closes below 98.86, we're going to say, oh, there's my short-term high, and now I start looking for the bull flag setup. Okay, now what I like to do on my chart when I'm doing my high-low analysis is try to identify where those highs and lows are, and I'll usually do that with a little gray box. So I'll do that today just so you can kind of see. But the next day here, we move the chart forward. The stock gives basically what we call a Harami candle. It did not close below the low of that, shooting star. It looks like we're consolidating here. This could go down, could go up. We don't really know, but all we know is it didn't close below 98.86. Okay, the next day though, over here, the next day, the stock does indeed close at 98.48. We close below the low of the high day, and for me, this establishes a short-term high in the trend, and now I can start looking for that bull flag setup that we just talked about. Okay, so here's my little high in the trend, and I could compare it to my previous highs, and I would assume, or I look at the chart and I think, well, that's higher than my last high. Okay, now what am I looking for? Well, let's go back to the slides real quick. What's the second part of the setup? Well, the second part's that 2 to 5 day pullback, right? So the 2 to 5 day pullback, now this is kind of interesting. You know, do we count this as 1 day, 2 days, or 3 days? Okay, now the first day here is a green candle, and it has the higher high on it. You know, I would probably look at this red candle as kind of the second pullback day for this reason. We have a lower high on the little Harami candle, and then we have another lower high here and a lower low. So I'm just starting to kind of draw in a little bit of a downward sloping, you know, resistance line. Does that make sense? You know, the flag itself, there's the flag pole, and so there's our picture starting to form up, okay? And I would like to see it pull back to an old resistance becoming new support. Now this is where this gets a little bit tricky sometimes, is we have this little consolidation here for 2 days, and so this may be the zone that we look for the pullback. Okay, so right into here could be interesting. We could look for it to maybe pull back to 96.45. You know, over in here we have some old resistance levels, so there's really quite a few places where someone might say, well, you know, all of those are potential levels of old support becoming new resistance. Now, again, if we go back to the slides, the most important part, at least for a bull flag, is to have a higher low in the trend. So this trading near support is just that third criteria. It's not maybe as critical as this fourth one, which is making the higher low. So, you know, if we're going to take a look at the higher low, we would have to say, well, where's my last low in the trend? Now, some traders might look at this low right here, where I've measured that flag pole from, which we'll talk about more in a second here. You know, some people might look at that as the last low in the trend, and some people might look at this as the last low in the trend. Okay, so this again is a little bit subjective on how you determine where those lows and highs are, but we're trying to basically get a feel. You know, here's a high, short-term high, short-term low over here, maybe a little bit lower highs, it's consolidating. And so now you get a little picture, okay? And so again, some traders might look at that as the last high, little 2-day, 3-day pullback, bullish Harami candle, bounced off the old resistance, made a short-term higher high. But basically, you want to be able to know where those levels are. So let me get rid of some of these lines because they're a little bit busy now. And as this pulls back, we're starting to look at this as an opportunity to find somewhere where that next low is going to be. Well, here we are, okay, yesterday. Okay, this is the 12th. Yesterday, the stock pulled back a little bit more, and we start to see this bull flag pattern start to form up. Okay, and so this is now the setup. Okay, this is that bull flag setup as of right this second, as of yesterday's close. Okay, we had a low at 98.16. If our last low in the trend is at 95.92, then this is a higher low, and we have those 4 setup criteria: higher high, you know, 1, 2, 3, 4, 1, 2, 3, 3-day pullback. We're getting near some of these old levels of resistance that might be support, and we can start doing this as now the setup. When we see the setup, basically our job as a technical swing trader is now to place an order. Okay, now we don't know if that order is going to get filled. This stock's not a recommendation. We're just going through this process of identifying the setup, and then we're going to talk about now the entry. So let's go back over here to our slides, and let's talk about the different ways that people may trade this setup. Okay, so we see the setup on the chart, and you know, this is basically the same graphic that we've used the whole time, but let's talk about the different entry signals that traders might decide to use. Okay, so the very first one's called anticipating the bounce. This is kind of like calling the bottom. Another term you may have heard is try to catch a falling knife, step out in front of the bus. I mean, this is the more aggressive type of entry. Now, the question is, well, why would somebody do that? Why would somebody assume that the stock's done going down? And here's really kind of the answer, right? You're looking at the trend, right? Let's say the trend is strongly bullish, and the stock's broken a resistance level, made the new high, 1, 2, 3, 4-day pullback, and now we have kind of a special condition at that potentially higher low. And this is really what those anticipating the bounce traders are looking for. They're looking for that bullish candle pattern near that support level. Just like we saw that shooting star that suggested the stock was maybe done going up, when we see a bullish candle pattern near support, we get that same type of feel. Like this candle pattern that I have on the graphic is actually a piercing line candle pattern. Now, we don't know for sure if this is going to go up, and that's why anticipating the bounce is a little bit more aggressive. But anticipating the bounce traders at the end of that day, when they actually see that piercing line candle, a bullish harami, hammer candle pattern, whatever it is, they'll look at that and they'll say, you know what, I'm going to go ahead and buy this stock right now. And they might buy it at the close or near the close of that day, and they're anticipating the stock holding that support and going back up. Okay, now that's a pretty aggressive method of trading these flags, or really any swing trade. Okay, all right. Now the advantage of doing that, obviously, is if that is the bottom, the stock goes up, you have the least amount of risk for the greatest potential reward. Okay, now if you're not that aggressive, then you could do what's called trading the bounce as it happens. This is not quite as aggressive as calling the bottom or anticipating the bounce. Basically, you're saying, I see the setup, I see my bull flag, I see the bullish candle near that support level, I see the stock making a higher low, I see all those criteria, but what I'm going to do is I'm going to wait for the stock to actually trade above the high of that bullish candle pattern or above the high of the low day. You may have heard the term CAHOLD, C-A-H-O-L-D, close above the high of the low day. Well, this is actually like a TAHOLD, trade above the high of the low day. So the stock trades above the high of the low day by some amount. Some traders will use like 5 cents or 10 cents or 20 cents. Some will use like a percentage, you know, 0.5%, 1%, you know, whatever it is. You get to choose that on your own. Our example on ESRX, we're going to use 20 cents above the high of the low day. The idea is with candle theory, and this is not 100% all the time, but what's kind of interesting about candles is when the momentum is bearish. Look at this little graphic here. When the momentum is bearish, the stock rarely trades above the high of that previous day. Let's just take a quick peek here. You know, as we look at these candles, you know, that's a high. This is a lower high, lower high, lower high. And basically the idea with momentum is that momentum is going to be bearish until it trades above the high of that particular day right there. If it trades above that, then a technical trader assumes that the momentum is now shifting back to the upside, and they're going to try to trade the bounce as it starts to happen, trying to catch that momentum in the change as early as possible. Okay, and so that's the idea with this trading the bounce. Now, in order to do that, you have to identify where that high of the low day is, and then you say, well, if that's at $42, then I'm going to put my entry at $42.20. 42.21 if it's 0.5% or whatever it is, right? So you're identifying the high of the low day. You'd also have to consider what time of the day. Do you want to get in early morning and hopefully catch a lot of bullish momentum to the upside like this big green candle that we see in our graphic? Or do you want to wait till the end of the day, maybe to avoid some of that early morning volatility and get in as it's trading above the high of the low day later on? Well, again, what's the advantage and disadvantage? Well, if you get in early on, you know, it's the advantage obviously is you're trying to catch that big bullish move off of the morning move or off of support. The disadvantage, of course, is it could do that in the early morning and then slam back down and not even close above the high of the low day where we don't even have a bounce, right? But that's kind of the idea, is you're trying to identify where that is. You'll have to practice. In fact, that's what I would like everyone in class to do today, is to practice identifying the setup, place these conditional orders that we're going to review today. Okay, so you know, once you've done that, you'd say, okay, if it goes above that by some amount, I'm in the trade, and that day right here, this would get you into the trade there, and it would cause you to execute whatever order you place. If you were buying an option, you'd probably get into that option trade. If you're selling a put, you might sell that put there. If you get into a stock trade, it's going to execute that order. Okay, now some people would say, well, yeah, but it closed above the high of the low day there, but you know, it's kind of a red candle. I don't like that. Well, welcome to the market. That's what's going to happen sometimes. Now, if you don't like either one of those entries, anticipating the bounce or trading the bounce as it happens, then you can do the CAHOLD. Okay, the hold is actually where we're actually confirming that bounce. We're waiting till the end of the day to close above the high of the low day. Okay, and so generally what you're looking for there is the stock is actually closing above the high of the low day. Generally, you're probably going to be looking at the end of the day, the last 20 to 30 minutes, so you can confirm that it is indeed closing above the high of the low day. You may come home from work and the market's closed, and you just place an order the next day. You're trading the bounce, but you're trading it on the next day. Okay, now again, you'll have to decide what exactly that means for you. You know, if that high, say at $42, if it closes at $42.01, is that high enough for you? You still may have to have some filtering mechanism. All right, so you know, this is how we define that bullish bounce. A close above the high of the low day. You may have something different for your entry. Now, there's a question here that says, so the hold has higher priority than being above the moving average, a 10-day moving average support line. Well, you know, I don't know if it has a higher priority. Hold is just what it is, okay? Hold means close above the high of the low day. We define, as a technical trader, a close above the high of the low day, we define that as a bullish bounce. Okay, now obviously with my explanation here, that may or may not be your entry signal, right? It just is what it is. A close above the high of the low day is when the stock's been pulling back, you have a low day and the stock literally closes above the high. That's all that is. Now, that may or may not be your entry. You may be an anticipate the bounce trader. You may be a trading the bounce as it happens trader. You may be confirming that bounce and actually be a literal hold trader. You're waiting for the close. So there's advantages and disadvantages of each of those entry styles. And so, you know, I remember when I first learned this, I was like, well, just tell me the best one and I'll just do that. Well, I don't know that there is a best one for everybody generally, but I think there is a best one for individuals. You can define for yourself what is the best way for you to trade a swing trade or a bull flag or a bounce off support. And frankly, the only way for you to do that is to practice each one of these in your paper money account, probably do 10 or 20 trades of each one, and then go back and analyze which ones do you like best, which ones are most comfortable for you, which ones can you do well. And so that's really all it takes, is it just takes some time and some practice. And, you know, generally speaking, if you're swing trading, the timing of a swing trade is generally pretty important, because swing traders have not only an entry, but they have a target when they get into a trade. Now, if you're doing intermediate or longer term trading where maybe the timing's not quite as critical, then you can, you know, play with different entries there. But if you're swing trading where you're literally trying to get in as close to support as you can and try to hit a potential price target, well, you can't really afford to give up, you know, 30, 40, 50% of that potential move you're looking for, which is why people use some of these other little bit more aggressive entries, is they're trying to get in as close to support as they can. Okay, so those are the different entries that we have. All right, now let's go back again and let's take a look at you know, the idea here obviously is to buy it and it bounces and makes a new high. Now let's talk about kind of the mechanics of placing a swing trade with our entry, stop, and targets, okay? So a swing target, you know, when you see the setup and you see, okay, there's the setup, I can see my bull flag or I can see my support bounce trade, we're planning the trade now. Okay, where are we going to get out if it goes good, and where are we going to get out if it goes against us? Okay, so we have a different targeting mechanism. The swing target, and this is true of a bull flag or really any support bounce type of trade, the swing target is the previous high. You know, when we were watching the stock go up and we're looking for that little pullback, the point at which it pulled back, that's the swing target. Okay, so in this example here, the swing target is that last high in the trend. Okay, the previous high, it's that higher high in the setup that we identified. Some traders would maybe try to get in there and they're literally looking for like a 2 or 3 day trade. Get in at support, sell it at that first resistance, and they're out. Okay, now obviously the stock could go up higher, and so some people will use what's called the flag target. Okay, the flag target is measuring the previous price move from support to resistance, and then we add that distance to the low of the low day or add that distance to your entry price. So for example, let's say we have this bull flag. Okay, the flag pole is that last bullish move. As it was going up, it would take that move. So if that was $4, for example, And well, we were using a $42 stock. So let's say that last move is like $3. So the stock went up about $3, and here we have the high of the low days at 42. Let's say the low of the low days at 43 or 42, or so. No, let's call it 41.50. So what you could do is you could add that $3 move to the low. So 41.50 plus 3 is 44.50. Or you could add it to the entry price. Now, you know, when you're doing this type of trade, a bull flag is often considered basically a breakout trade, but we refer to it as a bounce because it just seems like it makes a little more sense that way. But the idea here is a bull flag actually has this little downward price channel. Do you see that? And so the reason that someone might consider adding that distance to the entry price is because all price patterns are basically breakout patterns, right? They're breaking resistance, and usually when you're doing a breakout trade, you would measure your target from that breakout point. So if this move here again was, you know, we're saying $3, then someone would take their $3 and then move it off of there, and that would be where their target is $3 above that breakout point, or because we're using like 20 cents or 0.5%, fairly close to the high of the low day, we just use that entry price because it's a little bit easier maybe to calculate that. Okay, so you know, as we look at this here, we take that distance and we just measure it up there, and that's how we get our flag target. And there's other ways to do this. You can use a Fibonacci extension. You can use other different ways to pick a target. Again, how do you do this? How do you pick the best one for you? The only way you can do that is practice. I would suggest that you practice in your paper money account using some method. You know, if you want to measure the flag pole, well, do we go from the intraday low to the intraday high? Do I go from body to body on those candles? How do I do it? Okay, doesn't matter. Just be consistent with it. Some traders use the extreme low to the extreme high. Some traders use body to body. So measure that flag pole and then consider one of these entries. If you're a little more conservative, take that distance and add it to the low of the low day. If you're a little more aggressive on your targeting, add it to the entry price. But after you do that, you still have to evaluate whether you're even hitting the target. I talked with a gentleman who was using really extreme measurements on his flags, and he would set that flag up there, and it seemed like he was overly aggressive on his flag pole, and he would always use that for his entry target or for his flag target. And I asked him, I said, well, how often are you hitting your targets? He's like, never. Okay, if you're never hitting your target, then you need to change the method that you're using to get that target, because swing trading is all about getting in at support, basically hitting your target, closing the trade, taking your profit, and then going looking for another setup. That's what swing traders do. Okay, so you know, that's how we get the targeting. Now, just as important when you're targeting is sometimes the trades don't work. So you want to plan that exit, get out of the trade before you get in. And so now we also have our initial exit. Where's our exit if the trade goes against us? Generally speaking, because swing traders are setting up orders where they think support is going to hold, they basically say, hey, if I get in the trade and then a couple days later it breaks that support, I'm out. And so what they'll do is they'll set their initial exits below the low of that low day. That might be like 1% or 3% or some dollar amount below that low of the low day, because basically they're saying, well, I'm going to trade that change in momentum. If the momentum changes, then I don't expect it to make that lower low. I'm going to expect it to make a higher high and for the trend to continue. Okay, so that's where we set that initial exit again. Some traders will use 1%, 2%, 3%, depends on how volatile the stock is. Okay, so there's our numbers. All right, let's go back to ESRX now. And let's see what happens. Let's go back over here to ESRX. We see our setup, and then now let's plan this trade together. Okay. Now I'm going to remove this line here for a second. So we have our setup. There's the higher high, 1, 2, 3 day pullback. We have some old resistance zones in here. Maybe this is all the pullback that we get. We don't know if it's going to pull back another day. We don't really care if it pulls back another day. All we're saying is, hey, there's the setup if it trades above 99.02. That's the high of this low day. If it trades above 99.02 by some amount, then I want to trade it. Okay, that's all we're saying. All right, so here's the deal. Okay, now how much? Now for our example today, we'll just use 20 cents, but some traders might use 0.5%, some traders might use 25 cents. There's nothing inherently special about that. You just pick a number somewhere above that where you believe that that momentum is shifting, right? Here, lower high, lower high, lower high, trades above the high of that low day, and now we get a bounce, okay? Higher low, higher low, higher low, a little bit higher low even here, similar low, and then the momentum shifts. Lower high, lower high, lower high, lower high. And if it trades above 99.02, we're going to assume, okay, perhaps incorrectly, but we're going to assume as a technical trader and the stock that's in an uptrend that the momentum shifting back to the upside, we want to get in the trade and then take it up to wherever our target is. Okay, again, not a recommendation. This is just how swing traders think about swing trading. Okay, so let's go ahead and pretend that it's last night, we came home from work, put the kids down, and now we're looking to set up a new swing trade on ESRX. This is how we do it. Okay, so very first thing is we probably want to identify, well, what's our entry trigger? Well, the high of the low day, the high of the pullback candle here is 99.02. We can see that just right up here, this H value. Okay, so that day, 99.02. So let's use 20 cents. 99.22 is going to be our entry trigger. Okay, so we might write that down. I'm just going to write it down here on my page. 99.22 entry. All right, now we have to decide, well, where do I want to get out? Well, the swing target's up here at 143. Let's go ahead and draw a line up there. There's the swing target right there, $100.43. That's the swing target. Someone could choose to trade to 143. Well, what if somebody wanted to do that flag target? Well, then we take our trend line tool, we go off where we see the last low in the trend, and we draw it on up to the high. Well, that's $4.51. That's the flag pull. The flag pull distance is $4.51. So we write that down, and now we have a number that we can use to pick an upside target if we're going to go for that flag target. Okay, so let's plant that in there. And so now we have that distance. Let me show you something cool. So like if you don't have your box, the show label on hover, and now when I click OK, if I move my cursor over there, that box comes up. You see that? So now I've got that 451. If I didn't remember or write that down, then I could do that. Now, if we do the 451 and we're going to get in there at 99.22, we could say, well, 99.22 plus that 4.51, that's a 103.73 target. So let's put that up here somewhere. Okay, oops. Let's go here with our line. We'll put a line up in here, and we're just going to do 103.73, and we'll make it a big fat green line. Okay. So there's our flag target up there. Now, if I wanted to be a little more conservative on my target, I could say, well, the low is at 98.16, 98.16, and we measure that flag pull from the low of the low day, plus 4.51. And so we could have a target of 102.67, okay? So 102.67, no, 67. That right? So we'll put that just right there, 102.67. We'll just use a thinner green line on this one. Okay, so basically we have these kind of two different targeting areas. Does that make sense? Those targets, the low day here is about 86 cents wide, the range, the R value, just right here, this R value. That's 86 cents, and so, you know, the target should be about 86 cents plus that 20-cent entry buffer that we gave it. And so we've probably got about $1.06 difference there between those two lines. All right, but those would be two targets potentially for this trade. All right, how about the downside exit? Well, here's our pullback. If it bounces, now this is kind of the cool part about this. If it bounces, then it will activate these selling orders. If it never bounces, let's say it pulls back another day, well, then we just cancel this order and we put a new order in with a lower entry price, perhaps a little bit lower target, and perhaps a lower stop exit. Okay, so in this case here, the low's at 98.16. And if we take 98.16 times 0.99, that would give us a stop at 97.17, which is basically saying, hey, if we get into the trade, if it goes down to 97.17 or lower, then get me out of the trade. And as always, a stop order is going to execute a market order, so we don't know if we're going to get filled at 97.17. Could be potentially less than that, could be significantly less than that. All right, but 97.17, we'll draw a little line on there at 97.17, and we'll make this a fat red line. So we'll put it in there right at 17. We'll fatten it up a bit, and there's our stop. Okay, so basically we've got our trade planned out. We're going to say if it goes above 99.22, get me in the trade, and then we have to pick our target. So I wanted to show you a couple really cool things with this particular type of trading using the Thinkorswim Paper Money platform, as you can actually place an order to get out of not only one of these targets, but all of them or a couple of them. So let me show you first a way to trade stock with two targets. Okay, we're going to use the swing target for half the position, and we'll use this 103.73 for the other half of the position with an exit at 97.17. Check this out. Kind of a cool thing to do here. So we go to the trade page, we pull up our stock, ESRX, and here we're sitting at, and this is actually today's data. It's up 18 cents. It didn't quite hit, see the high today's at 98.72, so it did not hit that 99.02 trigger or 99.22 trigger, but we'll go ahead and place the order as if it was last night. Okay, so we're going to do a right click, buy custom with OCO bracket. Now the reason that you use an OCO bracket, that stands for one cancels other, is so that you can set up a stop and a target, or a stop and a target at the same time, and that way you can, you know, have these orders automatically execute. So if you're away from your desk or not watching your computer, those trades will happen. Now, so let me show you how to do like a single order first, and then we'll kind of complicate it or make it a little bit more interesting. Okay, so if I wanted to get in the trade at 99.02, I could put 99.02, but I don't want to use a limit order. Limit order says get me this price or better, so it's already lower than that. So this type of order would feel like right now. I don't want to buy it right now. I want to buy it only if it starts to shift back to the upside. So that's called a stop order. So basically we're saying, Mr. Broker, stop, don't do anything until it's 99.02, then I want you to buy 100 shares at the market. Okay, well, that can be a little bit scary. What if it gaps up like to $200? Well, I don't want to buy it then. So what we're going to do is do a stop limit here on the buy. We're going to say, Mr. Broker, I want you to trigger the order at 99.02, but I don't want to pay, or sorry, 99.22. Okay, that was 20 cents above the high of that low day. But I don't want to pay any more than, say, 99.52. And you can put whatever filter in you want. I just use 30 cents here. Some people use 20 cents. Some people, again, use $1, 50 cents, whatever it is. All right, so here we have now this little window. If the stock were to gap up above 99.52, this order would become active, but it would become active as a limit order at 99.52. So if the stock opened at 99.80, for example, it would have to pull back below 99.52 to fill the limit order, okay, which means it may not get filled. All right, now, if we were just going to use that one simple target, 103.73, we put a limit order up there. If we're going to use that stop at 97.17, we put 97.17 here, and we'd probably make all of this good till canceled, and that's it. That's all there is to this order. We're done. And we hit confirm and send, and we review the order. Say I want to buy 100 shares. Okay, now you may want to position size this if we get in at 99.50 or lower, and a stop at 97 or lower, right? Because that may not fill at that price. But we're going to be risking about $2.50 a share. If I buy 100 shares, that means I'm willing to lose at least $250 on this thing, because if I get in and then stopped out, which could happen significantly lower, then I'm going to lose about $250. If $250 is too much risk, then you just buy fewer shares. All right. Okay, so we're going to, review this order. Stop limit, trigger at 99.22, max out at 99.52. No guarantee to get that order filled. Won't become active until it gets above 99.22. Once that order fills, then we're going to try to sell it up at 103.73, which we calculated to be that bull flag price target. Or we're going to get stopped out at 97.17 because it didn't work. Okay, and then we'd, if we have a group, we might put that down in our swing trading group and send the order off. Now, I'm not going to send this one off right now because I've actually already done this prior to class. I just didn't want to miss it if it bounced. Okay, now that's kind of a cool order, right? But what if, what if you're saying to yourself, well, I don't know which of these targets it's going to hit. I want to sell some of the stock at the swing target and then some of the other at that flag target. How do we do that? Okay, this is really cool. Check this out. Now, let's go ahead and stay with the $100 shares here. Our entry is going to be the same. That's not going to change. What is going to change, though, is our targeting, right? Well, we have the flag target already built. Check this out. This is a cool feature. Come over here to Advanced Orders, come down to First Triggers to OCO, and then what you want to do is right-click, create a duplicate order on the stop and that limit target. And now I've got one buy order and two OCO orders. So what I want to do here is I'm going to put this at 50 shares for that flag target that we already built. And now we're going to put 50 shares here, and we could put a different target in there. Okay, we have our stop already there, but let's put the target $100.43. That's our swing target. So now I've got an order to buy 100 shares if it bounces, and then I have an order to sell half at the swing target and then the other half at that flag target. And so that's a great way to look at this if you're trying to get maybe scale out, trying to sell part of it there. And frankly, if it does hit that swing target, you may want to do something with your stop on the existing 50 shares. Okay, but this would be a way that you could now do what's called a First Triggers to OCO. And now you have an order to buy 100 shares at the same entry that we talked about, and we have now two exit orders to sell half at the flag target, half at the swing target, all of the shares down there at the stop at 97.17, which again is not guaranteed to get filled there. Okay, and then you'd send this off to your order. Now this is more like the order I did this morning. I did 200 shares and sold 100, sold 100. So that order is actually working. I'll show that to you now, but I just wanted to show you how to do that. But here's our ESRX order right here, basically the same idea, right? 99.22 stop, 99.52 limit, and then I've got the two exit orders, buy 200, sell 100, sell 100 on the exits, okay? Now that's kind of fun as a stock trade. Now a lot of people ask, well, how do you do this as an option trade? Can we trade an option on ESRX with the same kind of idea? And the answer is yes, we can. Okay, so let's say we want to buy a call option here, okay? So you'd have to decide, again, if you want some more information about options, Barb Armstrong does a great class called Getting Started with Options. It's on Friday afternoons at about, what time is that? 3 p.m. Eastern Time. And great review over and over again about what a call is, what a put is, these different types of trades. But we're going to do a long call option here. So we're going to, talk about this on kind of more of an intermediate level for the options here. But if I wanted to buy the option based on the stock price movement, it's easy. I just have to pick the option I want to trade. I'm going to come out to this January option here. I think one of the biggest mistakes new option traders make is they just don't buy enough time if they're going to be an option buyer. Hopefully this trades over in about 3, 4, 5, 7 days. But if it's not, then I've got some time buffer where the time decay doesn't kill me maybe as badly. Okay. All right. So here we are. Oof, these spreads are horrible. 210 to 375, $4 to $5, pretty nasty spread. Let's take a look here at the December options. These are really wide as well. So these guys had earnings here. Well, and this is could be a deal breaker for some option traders. These spreads are pretty wide right now. They may have an FDA approval pending that I'm not aware of. Wow. Yeah, these spreads are just really wide, and I don't know why that is exactly. There might be some news pending on ESRX, but actually with those type of numbers on the options, let's just forego the option trade, and we'll try to do we'll make that another time for our option trading. Okay, so here we are today. The stock is basically showing a little bit of a Harami type of candle so far. The body's inside yesterday's body. It's an inside day. Today's high is lower than yesterday's high. Today's low is higher than yesterday's low. So we call that an inside day. The body's inside the body of the previous day, so we call that a Harami candle. And so this is still a bull flag setup, still a bounce setup here. But those options just, for most option traders, they like the spread between the bid and ask to be as close as possible. Those were not very close. Okay, so we've got about 10 minutes or so left. Let me look at one more example here. I looked at some other stocks with the big sell-off yesterday. There were some stocks that still were making higher highs, pulling back into some higher lows. Let's take a look at what's going on MRK. Okay, so MRK, kind of similar to ESRX, went up there, made the new high, big bearish engulfing candle, a little bit of a hammer candle yesterday. The old high was right in here. So this could be our old high becoming new support right now. We have some of these other levels in here. The stock's trading near the 10-day moving average as of yesterday's low. So let's go ahead and do this setup here. This one's maybe a little bit more volatile. We can see some much bigger movements here, but let's take a look at MRK. We'll just do that same process and we'll go through it again together. Okay, so here we have basically a 1, 2, 3, 4-day rally, kind of capped off with a bearish engulfing up here where we make our high in the trend. It closed yesterday. The low of the bearish engulfing candle was 74.80. We closed at 74.69 yesterday, so we did close below the low of that high day, and so we could say, well, there's my high in the trend, and now I can compare my high and lows, and now I can start seeing whether or not I have a flag, right? Well, this may be all the pullback that we get. It's actually, yesterday's high was 75.27. Today's high is the same at 75.27. So we haven't traded above the high of the previous day or the high of the low day yet, but we traded to it, okay, which is why people will set their limits a little bit above that. So let's go through that same process again. And again, where we have a really volatile candle on our low, this does some weird things to your targeting. But let's go through the same mechanics we did on ESRX. Okay, we have identified our swing high at 75.99. That could be our swing target. Okay, the flag pull, if we use the extreme low to the extreme high, now we have a $5.87 flag pull. Okay, so I'm just writing that down, 587. We could add that 587 to the low of the low day or to our entry price. If we're going to use that same 20-cent entry, that would be 75.47. Okay, 75.47 is 20 cents above the high of yesterday's high. And some people, again, might use 0.5% or whatever. Okay, so we'll use 75.47 as our entry. The swing is 75.99. And the flag pull, if we do the same technique, right, this flag here, okay, so let's go over here and show it on the hover. And so that was 587. If we add 587 to 75.47, 75.47 plus 5.87, that gives us a pretty aggressive target at 81.34, okay? So let me move that down a little bit. So 81.34, that's up in here, okay? So 81.34, big old fat green line up there, okay? So that's the flagpole target if we use the same techniques and same entry method and same method of picking the target. Well, if we went off the low, 74.03. Okay, 74.03 plus 5.87. So that gives us a target of 79.90. Okay, so let's put 79.90 in there. We'll make that a little thin green line. Okay, so 79.90 is that little bit more conservative flag target. Now, the idea here is how do you know whether this is aggressive or not aggressive? Well, you know, if you look at the chart, you can go back and analyze kind of previous moves, right? You can take your trend line tool and say, well, you know, here's a little swing move off support. That moved about 3.7% or 250, okay? This little bounce moved about 2.5%. This one here moved about 2.78%. This one moved, this one here, I'm just measuring these little swing moves, 233. Okay, this one here before it kind of cratered, 3.45%. Now this one, as we got closer to earnings, got a little bit more volatile. That was a 8% move there on earnings. Holy cow, that one really shot up. That was 12%. And so what we're trying to decide is, based on some of the average type of movement, is this next move, is this move here that we're forecasting 8%, is that a normal type of move for this stock? And it looks like, you know, during the earnings and the market volatility, it was pretty normal, but I mean, really it looks like more like 3% or 4% is more normal, right? And so what a trader could do is decide, well, you know, here again, we used a really aggressive flag pull, right? We used a very aggressive flag pull with that extreme low. What if someone said, you know what, I'm going to kind of chop that off. I'm going to go from here up to there. And now it's a 5% move, still a little bit bigger than maybe some of those previous moves, but maybe a lot more reasonable. Okay, so that's $4.03. So I'm just showing you some different methods that traders can use and some logic behind why someone might use one target versus another. So let's use this 403, which is a little more conservative. We're getting rid of kind of the choppy volatility on that day. We're just going from the opening price up to the high here, which looks, again, fairly normal. And now let's go 403. So let's use our entry now at 75.47, but let's use 403, 75.47. 7, okay, plus 4.03, that little bit more conservative flag, and that gives us a target at 79.50, okay, which is up there, still pretty close, but I mean it's up there a little bit closer to that more conservative line, 79.50, and we'll just use that. Let's get rid of these other lines here. And we'll just draw this one right in there at 79.50. And again, this is not a recommendation. This is just a methodology that people use to, you know, determine where their price targets are and so on. Okay, the low of the low day is there at 74.03, 74.03 times 0.99. If we want to go 1%, some traders might use 2 or 3% below that. We'll go 73.28. on there for our exit. Okay, so we'll just duplicate that. We'll just drag it down here, and then we're gonna change the color. We'll go 73.28, and then we're gonna make that a red line. Okay, so there would be our stop, there would be our target, and our entry we said was at 75.47. Let's go place this order in the last few minutes of our class, and then we'll kind of wrap up. Okay, so trade page here, MRK. So again, if we want to buy the stock, we'll just use the one target. So we're going to do right-click, buy custom with OCO bracket. Okay, we're going to use a trigger point, again, 75.47 to get in the trade, not a limit order, but we're going to use that as stop limit, and will maybe give us ourselves, we did 30 cents last time, let's just use 20 cents this time, 75.67 for our little window that we've got to pick this up in. And we'll make that good till canceled. Our target we said was 79, what was it? I forgot. 79.50. Okay, 79.50 up there. And our stop we said was at 70 something, 73.28. So we'll put that in there, 73.28. And now we have 100 shares. If we get in at 75.60 and get out at 73, we're risking about $3 a share. You'd have to be okay with that. If you're not okay with that, then buy fewer shares. Okay, we hit confirm and send. Review the order. Okay, I want to get in there at 75.47. I want to sell those at 79.50, and I want to stop out there at 73.28. Again, no guaranteed to get filled at 73.28. It's just going to execute a market order for us, and we'll send this down into our swing trading group, and we'll send that off. Now, I think the spreads on this option are going to be better. Yes, much better. So 345 to 355, 198 to 201. Now, if we wanted to do this as an option trade, we could do the same thing. Let's go ahead and do this first strike in the money. Right-click, buy custom. Now, we can use the OCO bracket, or we can do this stop. This is kind of a cool feature. Is go in here, and we're just going to make these market orders because we don't know when this is going to trigger or if it's going to trigger. Be aware, again, we don't know what price this will fill at, so we want to be careful. If it gaps over that, we want to, you know, maybe cancel the order. Okay, so we hit our little gear, and we say if the stock Merck marks at or above, greater than or equal to, you know, that 75.47, then buy that call for me. Okay, and we hit save. Then we click on the gear on the selling order, and we say, okay, if Merck marks at or above the target. Okay, what did we say? 70, was it 79.50 for our upside target? And we can put a little second line in here if it goes at or below. What do we say? 73.28. Oops. 73.28. So now we have our numbers, and now we basically created an OCO order, but it's in this conditional order. Okay, save that, and let's say that option again is going to run us about $350. So if we're willing to lose $350 or more, we could do one contract. If we're willing to lose $700 or more, we could do two contracts. We'll just do the one contract here. Let's go double check our numbers. 73.28, 79.50. So when we hit confirm and send now, okay, we're saying I want to buy one contract of the January 72.50 call at the market if the stock goes above 75.47. Now this type of order is a market order, so again we don't know what price that will fill for, but we want to be careful. We want to keep an eye on the 75.47. If it's going to gap way over that like tomorrow morning, then we may want to cancel this order to avoid a bad fill price or paying too much for the option. Okay. If we get in there, then this selling order becomes active. It'll sell it at the target at 79.50 or higher, or it'll sell it below 73.28. Again, both market orders, no guarantee to get filled at what we think we should get filled at. Might be some slippage, might be some volatility involved, but we can do that as a conditional order to get in there on an option. And we do swing trading, we send that order, and now if the stock bounces today, which it doesn't look like it's doing, but if it bounces back above there today, that order will fill. Now what if it pulls back another couple of days? Well, we can just keep watching as this makes lower highs in the pullback. As long as it's still a bull flag, as long as it's still a swing trade setup, we could put that order in to buy that bounce off support. Okay, so anyway, what do I want you to do? I want you to take the things that we've gone through today, go look through your watch list. The penny increment watch list that's available to everybody on the public watch list is generally a resource of optionable stocks there that have decent spreads usually. Go through that watch list, look for that swing trade setup, and then maybe practice that conditional order that we did for the stock and the option there in the Thinkorswim Paper Money platform. If you want some more details on the technical analysis, you can go to the education page, and this will bring up, hopefully here, our different live events. We have a Strategies for Growth workshop coming up very soon, this weekend, I guess, here in Atlanta. This is where we go through technical analysis and options from kind of start, at the very, very start, kind of a basic level. I also mentioned earlier you can go see Barb Armstrong for getting started with options, and that's on Friday afternoon. And then we also have some great courses, trading options right here, technical analysis. Those will be the two best resources that you have for this. Okay, all right. So let's go back and just kind of wrap up today. What did we do? Well, we identified that short-term bullish swing trade setup, right? We determined our potential entry signals, price targets, initial exit orders, and how to get those, some logic behind some of that stuff. We went through how to place a conditional order on the Thinkorswim Paper Money trading platform. And stick around, well, not stick around, but later on here, later on, Mike Follett and Pat Mullally be coming up to do the splash for us here today, and they'll take you through. That's going to be about 1 p.m. Eastern time. So we'll see you next time. Remember, everything we've talked about today is for educational purposes. We did use some actual symbols. However, none of those symbols were meant to be recommendations. Any investment decision you make in your self-directed account is solely your responsibility. Have a great day, everybody. Thanks for being here. We'll see you next time.